Thanks a lot for joining us today. I'm Laura Suter, Personal Finance Analyst at AJ Bell. And today we're going to talk about ethical investing. So we're going to look at the rise in popularity of ethical investing, whether it's yet moved to the mainstream, what some of those drivers are. We're then going to look at the whole range of investment options out there in terms of ethical investing and how they've performed. And then particularly, I wanted to look at ethical investing in light of the coronavirus pandemic and in light of how markets and investor attitudes have changed this year. So if we dive right in, what we're seeing at the moment is that ethical investing is becoming of more interest to investors. So it's obviously not a new thing. There have been ESG funds, so environmental, social governance funds, around for a very long time, but it's always been a bit on the fringes of the investment community. What we're seeing now is that it starts to become more mainstream. So the logic behind this makes sense. As more people make more ethical and sustainable choices in other areas of their life, they're also doing that now in their investing. So where we've seen people's lives change in terms of small things from not using carrier bags anymore to larger things like using electric cars, we're now seeing them apply some of that same logic and focus on their investing as well. So there's some research from Morgan Stanley which shows that 3/4 of investors are interested in sustainable investing, and that actually rises among younger people. So the greater proportion of younger people are interested in ethical or responsible investing. But where we're at is that still only 2/5 of people have actually shifted into responsible investing, and that's probably also only a proportion of their portfolio rather than their entire portfolio. And so one of the difficulties, which we'll come into later, for advisors and for the investment industry is that everyone's definition of responsible or ethical is different. Everyone's coming from different viewpoints, and so it's the tricky thing for advisors is how do you appeal to your clients and how do you appeal to their particular definition of ethical, because there's no one-size-fits-all approach or product. So we did some research on this earlier this year, looking at AJ Bell customers and looking at their views on how important ethical investing is for them. And it really varies. We break it down by different age ranges. So you've got Gen Z, which are obviously the youngest, millennials, then Gen X, then the baby boomer generation, and then traditionalist, which is kind of those mid-70s onwards. And you'll see actually that while the figures vary across gender and across age, there is a lot of interest in ethical investing across the board. In the highest areas, you have millennial females, so they're most interested. So you've got just over 60% of them thinking that ethical investing is important. And then you contrast that with older males, so men in that traditionalist category, which is over 73 and above, where only 30% are interested in it. And what we're seeing is probably no real surprise in that millennials, so younger generations, and women are more interested in ethical investing, while older generations are least interested. But what I think is important to remember is generally people thought about millennials and younger investors being interested in ethical investing, but that wasn't really a big game changer for the industry because those people tend to be younger, they tend to have less money to invest, they're not as active investing, advisors aren't dealing with them. But while that millennial tag is thrown around a lot, it's actually that millennial generation has grown up and it now encompasses people going into their early 40s. So when you think about the demographic of those people, they're going to already have some decent pension built up, and quite a few of them will probably have quite a lot of investments built up as well. So where previously it was that younger generations were interested in ethical investing, but they didn't really have much money to back it up, what we're now seeing is that that generation has come of age, and where they have the money to put behind their ethical intentions, we're starting to see more flows come through. So it means that for the investment industry and the advisor industry, it's a more lucrative market to target. And that's probably partly why we're seeing ethical become a bit more mainstream. And if we look here at flows information, so this is from the Investment Association, which tracks how investors are spending their money, what they're investing in, the types of funds they're investing in, and they track flows into ethical funds. And as you can see, it's really taken off this year in comparison to last year and previous years. And I think this is particularly interesting when you think about the backdrop of this year. Markets haven't exactly been an easy place to be, and we've seen a lot of volatility in them. In some months, we've seen quite large outflows from lots of different sectors, but despite this, ethical flows have persisted. So if we look at the first 6 months of the year, so this data goes to the end of June, that's the most recent that's available. But if we look at that, then 4 billion of assets have flown into responsible funds, and that's even taking into account that big dip in March that you can see there, where obviously lots of sectors and lots of funds saw outflows. So then when you compare that to last year, that same 6-month period last year, there were only 800 million of flows in comparison to that 4 billion. And in the entire of 2019, there was only 3 billion of flows into ethical funds or responsible funds. So we can see that this year it's really picked up. And some of that will be more younger investors getting involved in investing. Some of that will be awareness. There was a lot of awareness last year, that kind of Greta effect, but also a lot of political talk about more environmental issues. So some of that will be that coming through, and some of it will be a direct reaction to COVID-19 as well. And one of the previous things that was always said about ethical investing is that in order to invest ethically, you had to sacrifice performance. And it's one of the areas that the industry for decades now has been trying to challenge and provide lots of evidence that it isn't necessarily the case. What I thought was interesting was to look at earlier this year. So if we look at the first 6 months of 2020 and look at the performance of ethical funds during that time in comparison to their kind of quote unquote non-ethical peers, but also to the broader market, ethical funds actually outperformed fairly significantly. And so in the 6 months to June, ethical funds rose by 1%, which is not particularly dramatic, but UK markets fell 8% during that time. So ethical funds were able to protect against a lot of the downside that the market saw. Now, this is obviously a small snapshot of performance, and what it's pinned down to broadly is that a lot of those ethical funds would have shunned the oil sector. Obviously, what we saw earlier this year was that the oil sector and oil companies got hit by a bit of a double whammy. So the oil price plummeted, which had an impact on those stocks, but also those stocks got dragged down by the wider kind of market falls as well. So they got hit by a double blow, and ethical funds managed to sidestep that, which means they managed to sidestep a lot of the falls in the market, partly because those oil giants make up such a big part of the UK market. But the second part to it is that a lot of those ethical funds that focus more on the sustainability aspect of ESG, they have a higher allocation to technology and healthcare companies, which is what's really driven market performance so far this year. So those funds will focus on companies that they think are the companies of the future, companies that are working sustainably and that have longevity to invest in. And so a lot of those tend to be in the technology and healthcare sector, which is obviously what has outperformed this year, particularly after the market falls. So what's interesting in this data, which runs to June, is that if you looked at the entire UK all companies sector, all of the funds in there, an ethical fund was actually the top performing. And so no UK all companies fund managed to achieve a positive return, but the best performance came from Royal London Sustainable Leaders Trust, which lost around 2%. And that was for those reasons I've just talked about, in that it sidestepped the oil sector and it has high allocation to technology and healthcare stocks. So that's obviously over a shorter period, but what about over the longer term? And I think here, this is kind of relatively crude performance metrics, but I think it's interesting to look at. So if we take the UK all companies sector, and we pull out the ethical funds within that sector, that's a relatively small group in comparison to the whole sector. So there's 13 funds that are run to ethical mandates in that sector. And we compare their average with the whole sector average, and also then with the FTSE All Share. What you see is that over all of those time periods that you can see on the slide, there's only one where ethical funds didn't outperform both their peer group and the FTSE All Share, so the relevant index. And that one period is over the past 3 months, where the average UK all companies fund returns slightly more, so kind of 0.5% more than the average ethical fund. So whilst it's only kind of a snapshot of data over a long period of time, it shows that it's interesting to see that even in falling markets, ethical funds have managed to protect on the downside, but also in rising markets, they've managed to outperform. But obviously within that set of ethical funds, it's very hard to come up with comparison tools to compare all of these ethical funds. There's no one sector for them, and nor really should there be, because they span such a different wide range of investment options, obviously from global to UK to bonds. They also span a massively wide range of approaches, and so investors need to work out which one works for them. As I talked about earlier, everyone's kind of definition of responsible investing is very different. One person might think that giving up plastic carrier bags is sufficient to live an ethical life, or an environmentally aware life, where someone else might want to take their entire energy supply for their house off-grid and rely entirely on renewables. So that's just one example of kind of how people can differ, but also how investors need to take into account how funds operate in very different ways. So quite often you'll look at the top 10 or the full holdings breakdown of an ethical fund, and it'll have some quite surprising companies in there. It might have some of the oil giants in there, or big energy companies, or it might have companies that you wouldn't previously really think of as ethical companies, even if you wouldn't necessarily think of them as unethical companies. The argument that a lot of fund managers make is that it's better to be invested in that company, have a seat at the table, be able to put forward opinions and be able to agitate for change from inside that company, and push for that company to become more sustainable, or more environmentally aware. And by doing that, you would hope to improve their returns in future, because if you're making the company more sustainable and operate more ethically, then you would hope to see that in the results. Some people might be okay with that. Other people would definitely balk at the idea of, for example, their ethical fund investing in an oil company. The other option is that funds will only invest in good companies. So they'll only invest in those companies that are explicitly delivering an ethical mandate or an environmentally sound mandate. And that might be much better aligned to some investors. There's no right approach, and there's definitely a lot of variation of approach out there, but it's important to work out what's important to the client and to match that. The issue in the ethical industry also is that there's no standardization. You can kind of whack an ethical badge on any fund, and there's no criteria that you have to meet before you use that. Lots of people, lots of fund companies will use these terms in very different ways and varying degrees of them. So the Investment Association's talked about standardizing the ethical fund industry a bit more, and so it's talked about bringing in an approved ethical label that would have certain criteria that funds have to meet to be eligible, and that would help to compare within sectors. So you're looking for a UK equity fund, for example, and you could go to that sector, and something that was badged up as ethical, you know, would meet certain criteria for being ethical. And it would stop this so-called greenwashing of funds, because as we're seeing more flows pick up and more investor money going into these strategies, we're also seeing some cynical fund groups focusing on grabbing some of that asset flow and badging up funds as just ethical or green or sustainable, when actually their processes don't necessarily back that up. And so it means that it's quite the research job for investors and advisors to really dig through and work out how a company is backing up that ethical stance. Lots of firms might have a real focus on it. They might have an entire dedicated ethical team who screen all of the different stocks and bonds out there for how ethical they are and how sustainable they are and how much they meet certain criteria, where others might just have a kind of tick box process that's much more light touch. So it's important, unfortunately, to drill down until there is that standardization in the industry. And it's important to work out how these companies are adopting these ethical strategies and whether that is a stance that's enough for you or for investors, or whether they need to go a bit further. But I think it's also important to think of ethical investing in light of COVID-19 and the current crisis. So what we've seen is there's been a very interesting time to look at companies and compare different companies. So what we've had is a bit of a kind of leveling out in terms of every company had to react to this crisis at the same time. And while they operated in different industries, had different relationships with customers and were affected in greater or lesser degree by the pandemic, what we had was all of these companies having to make very quick decisions around things like how they treated customers, how much they contributed to local communities, how they treated staff, what they did with staff pay. So it's been quite a good way of consumers and also investors comparing these companies and comparing their approaches. And obviously out of this, you've had the good, the bad and the ugly. So you've had examples of things like, if we look at some of the examples here, Morrison's, obviously supermarkets did very well out of the pandemic, but it would have been easy for a lot of those companies to just keep all of that profit themselves, but they've donated money to food banks, they've given bonuses for staff for working on the front line, they offered enhanced sick pay for staff if they were affected by the pandemic. So they kind of really came out and supported communities as well. Then you maybe contrast that with a company like Sports Direct, which obviously wasn't necessarily known for its kind of ethical and great governance beforehand, but they hiked the price of a lot of the in-demand goods that people wanted to buy early lockdown. They also did not treat staff particularly well in that initial period. Another example that was very high profile was obviously Wetherspoons, who talked about not paying staff and not furloughing staff. So I think then you contrast that with something like Burberry, for example, where they quickly converted their factories into making hospital gowns and masks, into making their usual clothes. So I think what you've got here is consumers are able to very easily compare different companies across different sectors and see how they're reacted. And there's actually websites set up and devoted to people being able to check how a company reacted in COVID-19 for them to determine whether they want to spend their money with them. And so previously, I think we've seen a lot of focus on the E part of ESG, but I think now there's going to be more focus on sustainability and governance. So how did a company operate in COVID-19? How will that relate to their customer experiences and to their future ability to get customers? And how does that feed into investing in these companies? The caveat to this is that obviously everyone has a very short memory and it's very easy to forget about the bad companies and just be lured into shopping and going to the same places that you would have previously. But I do genuinely think that there is going to be more of a focus, particularly from shareholders and from investors, on what companies are doing to help staff, to help in the community, what they're doing to kind of help from a sustainable aspect through the pandemic until we get to the conclusion of it. But then also beyond that, I think that has put a spotlight on sustainability, and that will feed into investing and into the fund industry. And then I thought it would be useful to just talk a bit about how we're responding to this growth in demand for ethical investing. So we've added 4 new ethical funds to the favourite funds list, or to fundamentals. So there's now a total of 5 funds on that list, and they span different sectors. So you can see there we've got bond funds, we've got UK actually focused fund, more globally focused funds. There's more information on each of these funds on the website, where you can go through and look at how we made that selection criteria, how we determined that those funds were truly ethical and had those kind of ethical and sustainable processes embedded in the stock selection or the bond selection. And we've also got some exciting new product developments coming out later this year from the investment team. So we've got some stuff in the pipeline to help meet this ethical demand that's coming from both direct customers and from advisors seeing the demand. So keep an eye out for that later this year. So thanks very much for joining me. Definitely send through any questions that you have, and we'll see you at the next webinar. Thank you.